Happy Wednesday. Tiffany Ingram here with eXp Realty. I have Jason Browning with Academy Mortgage who is joining me again today, and we are talking about mortgage interest rates. Um, Many of you may be, really don't have an understanding about what an interest rate is, the difference between the federal interest rate. We hear a lot of buzz about, oh, Fed rates are going down, and people may really not understand what that really means and who that really affects. So we're going to get into it and we're going to talk about that today. Again, I have Jason Browning with Academy Mortgage. Jason, tell us, what is an interest rate?
Well, thank you so much, Tiffany, for having me again. I'm looking forward to this discussion. This is obviously a very important part of the overall process when it comes to buying a home. The interest rate, just a simple definition of that is how much interest is paid by a borrower for the money that they borrowed. And you definitely don't want to confuse this with APR. I get that a lot. So what's your APR? What is your interest rate? A person would use the interest rate to actually calculate their monthly payment, not the APR. What you would use that APR for is to see the cost of the money borrowed when you roll it into a closing cost figure. And this is really where you can start to compare with other lenders. Your APR is at, let's say this, and then the other lender's APR is higher. You know that there's more cost involved in that loan. It's not just as necessarily a rate conversation, if that makes sense.
Great. That's a good explanation. I think it's good for people to understand the difference between the two. How do buyers position themselves to qualify to get the most competitive rate?
Well, that's a very good question. It's going to come down to, it's going to sound like a really simple answer, and I don't mean it to come across that way, but it's really going to be about making sure that you're maintaining the highest possible credit score. Make sure that you can maintain your employment if you can. I know this is a very tough time for everyone. Making sure that you're able to stay employed is very, very important. But a big factor in everything is just, pay the bills, look at ways to lower the overall amount of credit that you owe. Don't open any new credit if at all possible. And then one thing, a lot of this news out there about forbearance and deferment of payments, making sure that you really have an understanding of what that means, and only go into forbearance if you must. If it's a situation where you don't have the money to make the payment, then you look at that forbearance option or some of the deferment options that are out there with maybe a car loan or such. But really knowing that if you do go into forbearance, it can have an impact on your overall opportunities of maybe looking at refinancing a loan if you're already in a mortgage. Sometimes some of the information that we're getting now is you may have to wait up to 12 months to do a refinance if you did a forbearance on your mortgage. Also knowing what that means is it's not a forgiveness or pushing those payments to the end of the loan. It's saying you're putting the pause button on, and when that forbearance is over, really what a lot of servicing departments are looking at is, say it was a 6-month forbearance, and on that 7th month you come out, well, you're basically going to owe 7 months of mortgage payments. And most of the time you're not going to have 7 months stockpile to pay all at one lump sum. And then at that point, you're going to have to go into some type of a repayment plan or a loan modification, and that's not going to be a good situation for you as well.
So the gist of the understanding should be that forbearance does not equal forgiveness.
Oh, absolutely correct. And it's not a deferment either. That's the, I think there's been some misinformation put out there in the press that a forbearance is a deferment, and it is absolutely not a deferment. It's a pause button. And as soon as you press play, you got to start paying what was currently due.
Now, Jason, is it true that in or during the forbearance period that mortgagees can actually make payments during that forbearance period if they're able?
Yeah, if they're able. It's really, I know this gets really, really tricky. And, I think this is all about lenders and servicing companies trying to look at the ability for someone to repay. Now, that's all what about lending is all about, the ability to someone to repay. So some of these servicing companies and some of these lenders, if you even pick up the phone and call them and say, what are my options about forbearance? They're tagging you as in forbearance. So you really just want to make sure that you know your options before you pick up the phone, knowing that that's kind of like a last resort. You can make those payments, but we're seeing credit reports coming in now where people are already taking advantage of the forbearance. And again, not trying to deter anyone from doing that, just don't do it just because you can. They did not put any kind of restrictions out there showing that you need to be, that you have to have proof that you're in a financial hardship to apply for the forbearance. They just said you can do it. So people are taking advantage of that, which is their right, but only do it if you have to, in my opinion.
Got it. Got it. Not forgiveness does not equal deferment, and you need to be able to pay the entire sum of the forbearance period at the end of that forbearance.
Right, and another important thing too is, if you just recently closed on a home, making sure that if you absolutely can, make that first payment, because that's where a lot of servicing companies right now are taking a big hit. Is if you go into forbearance on that very first payment, even though it's not a default, you're not making the first payment, and it's almost viewed as a first payment default, thus making that loan unsellable, which is a very a tough task to overcome as a lender.
Wow. Okay. Great. Awesome. Let's switch gears a little bit and let's talk about federal interest rates. A lot of times we hear buzz out there about, the Fed rates have, decreased, or, they've dropped the rates is the buzz that we hear. But what does the federal interest rate, or how does the federal interest rate affect consumers, and who truly benefits the most from this rate decrease or increase?
Yeah, that's a very, very good question. So I would say let's start with the question of what is the Fed funds rate? What does that mean? So that's going to be the rate that banks and other depository institutions use to lend to one another. So when you hear that, some of those buzzwords like you were just saying, the Fed rate, Fed funds rate, a lot of people just automatically think they're talking about the interest rates that you and I would get on car loans or home loans, things of that nature. And that couldn't be any further from the truth. That is basically the rate that banks can lend to one another. And they actually, when all this COVID-19 started, trying to stimulate the economy a little bit or not go into a recession as fast, they talked about taking that Fed funds rate from 1.25 or 1.15 down to 0.25 or to zero, just making it easier for banks to lend to one another and do it quickly. That's what that was all about. And really how that kind of going back to how that affects consumers. This is an analogy that I like to use, and I think I may have shared this with you in the past. It's almost like saying compare this to comparing the cost of oil to the cost of a gallon of milk. So when OPEC announces that they're going to cut the price of a barrel of oil, how does that affect the price of milk? Well, it doesn't until the effect of the price cut has a chance to manifest itself through their overall supply chain. So basically saying if oil is cheaper, transportation costs are cheaper, which lowers the cost of all goods, including milk. So it's not necessarily a direct correlation of saying when they cut the Fed funds rate, that doesn't right away cut the interest rates for consumer financing. But over time, it definitely can trickle down to lowering overall rates for mortgages. Does that make sense?
It does, because if I understand correctly, the difference between the rate that the Fed is charging the banks and the difference between what the bank is then charging the consumer, there could be 2 or 3, 4 point difference, right?
Oh, absolutely. Initially when that first came out, I had so many calls saying, well, here rates are at zero, let's refinance. Having to unpack all that and explain that, it's a little bit of a different conversation. Again, it was all over the headlines, all over the news. Trump was talking about it. It's a little confusing to say in the least.
Yeah. There definitely is some misconceptions out there regarding the difference between the two. So thank you for clarifying and clearing that up for us.
Well, and the second part of your question there was,
yes,
who really benefits from these rates? And like we said, initially it's going to be those banks. They're going to be able to lend freely, between each other and at little to no cost. But then over time, it will bring those rates down to those historic lows that we're seeing today, and it should help maintain those historic lows as well.
And regardless of where the Fed rates are today, you may agree with me now, is we're in a very unique market. Usually and again, this is somewhat subjective, right? But right now, it's a good time to sell and it's a good time to buy,
I would agree
right?
with
Just
I would
because of
agree.
where we are. And I don't know that we've been here in the history of real estate, but we're here now. So people that are on the fence really should make a decision, you know, during these times, if they want to sell their home and maybe transition into another home because rates are fair. If they want to, if they're moving out of, maybe a rental and they want to actually begin to uh, put equity into something that they can now begin to own, right? Now is the time to do that.
I couldn't agree with you more there. I mean, really what you're looking at there is it's a two-pronged attack. So if you're a current homeowner and you're looking to upsize, sell your home and upsize, what that's going to allow you to do from the selling standpoint is it's going to give you more opportunities for buyers. So there's going to be a bigger a bucket of buyers that can come in and make an offer. There's going to be more qualified buyers that can hit that price point. And then for you, it's going to allow you to get your home sold as the seller, and then also you're going to be able to go out with these lower interest rates and have a higher price point yourself. So again, you're going to be able to buy more. You're going to be able to have more people attracted to your home. So it's like a win-win, as it's said.
Absolutely, absolutely, I agree. So now that we've kind of talked about that, now that the state is slowly opening back up, do you anticipate some leniency with buyer qualifications? Because I know that, when we entered into this COVID-19 shelter in place situation, lenders really began to pull back the reins a bit, and they actually, I guess, they weren't as lenient. There were some stricter requirements to lending. So do you think that will be lifted? Do you think we can see that lifted here in the coming weeks, months? What are you seeing or hearing?
I think those conversations are already starting. We had a town hall meeting earlier today, and I think within a couple of weeks, we're going to have some of our guidelines loosen up a little bit. And again, it's kind of back to what I said a moment ago: the ability to repay. So as things loosen up, people are getting back to work, people are employed. It's kind of hitting that pause button that they hit for working is going to be hitting the play button again. So yes, I think that is going to allow us to loosen those reins, so to say, and get back to some of the the new normal with the programs. FICO's coming down, debt ratios kind of going back to where they were before. And again, I don't think it's going to be an overnight thing. We'll see a gradual improvement. And then the other thing that we really have to be careful of here too is we don't want to go so fast that if there's a second wave of this, that we have to go backwards. So I think what we're trying to do is a strategic way of loosening this up to where you have to loosen and tighten and loosen and tighten, but really just kind of be consistent with that goal, with that plan all the way through.
And I think, as with anything during this time, we have to use wisdom. That's going to be the most important thing, right? The things that were in place to keep us safe, keep us well, we still need to be sure that we are employing those very same actions, right? So I think those are going to be important things. Now, Jason, is there anything else you would like to share with our listeners regarding rates that perhaps we haven't already covered in this discussion?
Yeah, one of the things I like to talk to my clients about, our clients together, we're always taught to focus on rate. Are you getting the best rate? What's your rate? What's the APR? What I like to do there is maybe shift the mindset a little. Now, I'm not saying that don't look for the best rate. Obviously, that's what we want to do. But what this is going to do is drive my next comment. What should we be looking at when you're sitting there trying to get someone pre-approved? And one of my first conversation points with a new potential buyer is, what is your budget? What are you looking to pay per month? So it's the payment. It's the monthly payment that's trying to get to your budget. It's about putting the proper financing in place to make sure that we're taking advantage of the best rates and terms out there. but most importantly, getting to you, getting an affordable payment out there for you. And I hope that makes sense, but it's just really about, rates are important. Again, they kind of go hand in hand. If you have a very, very good rate, more than likely it's going to be closer to meeting your budget, if not meeting your budget. But again, it's really focusing on what am I going to be writing every month for that monthly payment, and does that meet my budget?
Right, because what's the point of having a new house if you're house poor? So you definitely don't want to be in a situation, and I think it's great that you as a lender, also make sure that the buyer is sure that they can, affordability, right? I mean, I want to sell homes, I want to help buyers and sellers, but I don't want to help them at the expense of them being house poor and not not being able to enjoy the home. So I think that's a very, very key factor that those that are, maybe used to renting, first-time home buyers want to really make sure that they have a clear picture of what their budget is. If you were a Dave Ramsey fan, which some people are, some people aren't, but I'm not here to pub Dave Ramsey, but I am here to just speak a point. 1/4 of your monthly income is what he recommends. And so that's a good starting point.
Right, and it's not about what you can afford, it's what you should afford. But, like I said, the first comment is like, what do you want your budget to be? And when I'm doing my pre-approvals for folks, the first thing I do is I say, well, this is what you want to spend, and this is the purchase price that you want. Do those two meet? If I'm looking for a $300,000 home, but I want to make a $1,000 payment, do those connect? Mm-hmm. So then you got to really kind of backtrack from there. And I hear a lot of lenders out there, they will actually just, they'll max out the pre-approval. This is the max you can buy, and they'll send them this pre-approval letter or pre-qualification letter. And that's not really meeting their needs. Hey, this is what you should do versus this is what, you can do. It's a totally different conversation. And you really want to make sure that you're setting them up for success. And like you said, not being house poor.
And I think that's where we all have to come together. And that's why working as a team is so important, because you have to be with a lender that it's not just about getting the deal closed. While that's important, they do need to be able to get the ball over the fence, right? But not at the expense of the consumer, ever.
Correct. I agree with you 100%.
Awesome. Great. Well, Jason, hey, this was another great call, meeting, webcast, whatever. This is fun. This is fun. I do like these. I do enjoy these. I do, again, thank you for your time. Hey, if there's anything else that people are saying they want to hear about and it's concerning mortgage, interest rates, whatever, I'll definitely be calling on you again. I hope that's okay.
Absolutely. I'm here when you need me, and I just appreciate you having me, and you guys take care and be safe out there.
You do the same. Thank you, Jason.
Bye now.